quickly hop off and then start the event officially, or I could just start it from here.
Okay, let's just get it started, eh? I'm just gonna share my screen here.
Yeah, I think like in 30 seconds it should auto start anyway. So what I'll do is
a bit of time.
Yeah. What I'll do is I'll put out an announcement that we are starting, and we'll give it a few minutes as always, and we can get this show on the road.
Good man.
Yes, let's go ahead and get my permissions. Yeah, it should now auto start our event. Is that correct? Did it do that? I'm not sure that it did actually. Let me go ahead and go there and start it manually. Yeah, okay. So I started the event manually now.
Okay.
That does, yes, it has now officially started. What I'll do now is I'll go to global and put out an announcement. And meanwhile, we'll probably see some people trickling in. Alpha is here now. Mouse is still here, so people will start trickling in.
All right.
So at everyone, come join Andrew.
We'll get started in a minute, guys. Just wait for a few people to drop in.
Yes, sir. As always, guys, you know the drill. 5 minutes, and then we'll get started. I'm going to put out the announcement right now, so we have some more people, so everybody knows that we're starting. Join us right here. And then I will just need the link to the event, which is right here. This should do it. Good stuff. Let me share it in general chat as well. And I will also share it on Telegram.
If you're watching this on YouTube, we're going to get started in a second. Just waiting for a few people to join in the Discord server, and then we'll get going.
Good to have you again, Andrew. I really enjoyed the last session that you did as well.
Yeah, no, I thought it was pretty good. We're going to recap that again, just as a kind of quick recap, just to go over what it was for those that didn't get a chance to watch, or maybe have missed the first one, and also because it's getting recorded, those who don't get to see it live will at least be able to get back and watch it on replay on YouTube Direct.
That's right. Yes.
What I wouldn't mind you doing, Frido, if you can, is just keeping me on time with the agenda. I want to try to follow that as much as I can if possible.
Yeah, that's fine. Sounds good to me. So the agenda that we have laid out in the like right here, like the session 1 recap, price action, trading, importance of volume, etc.
Perfect.
Did you? Yes, I will keep it handy so I can assist you with that.
The first point I'm going to raise actually is why my system isn't so great for Foxify. Well, it's not that. It's how does my system need to be adapted for Foxify? That's what I'll cover.
Cool.
So you let me know when there's enough in the server to get kicked off, and I'll get going, my friend.
Yeah, we'll do it in, like, we have 1 minute left, so at 5 minutes past, we can go ahead and start. And then along the way, people will most likely still come trickling in. as always. So yeah, I say we just started 5 minutes past,
Sounds good to me.
like we always do.
All right. Okie dokie.
Cool, cool, cool. Yeah, I'm looking forward to tomorrow. Actually, also, I'm looking forward to this session, and then I'm looking forward to tomorrow, hoping it will be a more volatile day for Bitcoin. Because today has been, if I may say so, a snooze fest. It was boring trading Bitcoin today.
Yeah, we already have a debate with Robin. He's countering
Yeah,
my argument, which is good. I like that. Healthy debate, Robin. Good
nice,
man.
nice.
It's because you don't. I'll show you specifically how I trade, right? And I guess some of the differences and nuances when you're trading with much larger capital versus what that means when you're trading with smaller capital, but the requirement for higher leverage. For me, that's really what caught me off on the funded, and I'll explain
Hmm.
exactly what that was, so it's crystal clear for everyone.
Cool. It is 5 minutes past, so I will turn off my camera. The stage is yours. And
Okay,
yeah, if there's anything you need from me, you need merely ask.
guys, I'm monitoring. As you can see, I'm monitoring the questions that come through in the actual chat itself. So if you've got any questions, if there's anything that I'm saying too quick, or you didn't catch it, or you need me to explain it again, please do ask. I don't mind stopping and reiterating if anything needs to be readdressed, okay? Because there's a lot to cover, and sometimes I have a habit of going down into a dark corner sometimes with this stuff, but it's because I live and breathe it, right? So that's what I would say. If there's anything you need clarifying, just drop a note. And I would say the same, if anyone's watching live on YouTube, just drop a comment. I can see Damila is watching on YouTube. So look, first things first, the thing I want to cover, right, is just a quick recap on the key things that I'm looking for when I trade. So what you can see on the chart right now, can you guys see like random candles? Some of them have colors and some of them are gray, some of them are white, some of them are red, some of them are green, some of them are orange. Can you guys see that?
Yeah, it's like a multicolored
It,
array of yeah of bars.
well, this is basically called, it's a indicator called the volume suite by Leviathan. And there's some really key information in these coloured candles, right, which tells you that there's something changing in the market, something quite dynamic. When you just see, if you just see the grey or the white, what that really indicates is it's just relative volume, meaning the tick volume, or the amount of volume that's coming into each candle, is proportionate to the last 10 candles, right? So when you see a colour change, something is happening. Usually, if it's red or green, it is 300% more tick volume than the previous 10 candles. So that just tells you at a glance that there's something significant happening. Sometimes it can be more money's coming into Bitcoin or the chart or whatever you're trading, to the positive side, or sometimes it can be to the negative side, meaning it can go down as well. You can clearly see on the big moves, like you can see here, right? If I just zoom in, you can see that color change there. That signifies that volume or something has happened specifically. That was 1 p.m. on Friday, but we had this is on the 1 hour time frame at the moment, but you can see over a sustained period of time, 1, 2, 3, 4, 5, 6, 7 hours, it was pretty bearish, right? Big red candles. So you know, the first thing you're looking at is on that second red candle, it went from a lighter red to a darker red. So that signifies more volume keeps coming in and it's bearish, right? I'm not going to talk about this yet. This is CVD, but it all kind of adds into the flavor. But for me, when I'm trading, and I'm normally on the 1 minute, right? So I'm going to switch to the 1 minute. By the way, if you hit Control R or Option R, it just resets your trading view screen. Just a little bit of a shortcut there. Just Control R. But you can see it here, even on the 1 minute time frame, right? You can clearly see at a glance where activities occurring. You can see big green candle here, a lot more tick volume than the previous 10 candles. It's just nice to know where to look on the charts rather than just seeing red or green, right? Red being a bearish candle and green being a bullish candle. That's all right, but it doesn't give you any statistics about what's going on. So I always like to have this indicator. It's purely about volume. right, or volume spread analysis, but basically relative to the actual previous 10 candles. So that's what each candle is representing. So that's just what that is there. The second thing I want to show you, right, and I'm going to go to the 5 minutes for this. So this is how I trade. You can see this is where the session started for Bitcoin today. It started at 1 a.m. UK time. So it's Asian session starting of the night, moving into London session, moving into New York session, even though it is, it's Monday, isn't it? So that is a valid statement. What I'm looking for is exhaustion. What you're looking at here is the VWAP. This is the volume weighted average price. Now what that means is essentially for the session, right? So a session is the moment the market opens to the moment the market closes. So that's for, like, in traditional trading sense, not perpetual futures, right? Because there really isn't any a session open or start and close. It's just perpetual. But typically markets open, you know, Asia session opens, and then you have an hour overlap where Asia is still trading, but London opens an hour earlier, and then you get an overlap where New York opens while London's still got 2 hours of trading. So there's these session overlaps, but the totality of those 3 trading sessions, and there's more, there's Hong Kong, there's Australia has one, Frankfurt has one, they all kind of open in and about the day. But the 3 key major sessions is Asia, London and New York. And so when I have my VWAP on, which is this line here, it's for the entirety of that session. So usually it's from about 11 o'clock at night UK time right the way through to 10 p.m. at night. There's 1 hour gap. And so even when we're trading perpetuals or whatever we're trading, we always need to think about what that session is. And that's this line here is just the split of the session. So that's when trading finishes and the next trading session starts. So when I've got my VWAP, it's the daily session VWAP, which basically means the whole session for one day, and then it'll reset and then it'll start again. And it's just purely calculated on price action and volume. And the reason that's significant and important is because you want to know proportionately where's the true value of the session. And so that's what the VWAP represents. It represents the true value of the session. So, like, you know, depending on where the highest amount of volumes come in the day, if more volumes come in at a specific price action, it will move the VWAP up or down depending on where that's happened. So right now you would say we are above VWAP. As the price is moving away, the true value of Bitcoin for the session is here at this white line. So we're above value. So kind of the way your mind needs to think about that is, realistically, you're buying above value. So if you buy Bitcoin above value, it's necessarily not the greatest thing. Really, you want to be buying below the VWAP and you want to be selling above the VWAP. Now, we're really only interested in trading, right? Foxify, amazing platform. Really, it's about trading for the day, getting in and getting out. This isn't about spot buys or holding or anything like that. It's just about where can you get in at a nice point on the chart to buy or sell at a point that's relevant to you, right? So the way I use it purely is on a sessional basis. And so what I'm looking for is, when are we so far away from value that we can expect a reversal? And so what these lines represent is standard deviations. And I'm going to show you exactly what a standard deviation is, because if it doesn't make sense to you, it can be a little bit confusing. So what you're looking at here is a standard deviation chart. It's the same for any, it's a data set basically, right? It could be on pupils taking a math test or some data set. It doesn't really matter what it is. But what the analysis shows more often than not is that the majority of the time on a data set, 68.2% of the time, it's going to stay within one standard deviation of the mean. So imagine that this 0 point here is effectively VWAP, right? This white line here is 0 on this chart. So you can almost flip that on its side, right? Where that 0 point line is, this 34.1% to the negative side or 34.1% to the positive side is just a 68.2% deviation, which is one standard deviation mean. It's to say the majority of the session you expect 68% of the time for price to be within 1 standard deviation away from VWAP, right? When you're getting close to 2 standard deviations, if you add both the outer, so the second standard deviation, it's 13.6 on one side, 38.6 on the other side. So what's that, 27.2% or whatever it would be. So there's the only 27.2% likelihood of the price being at second standard deviation during the session. And then the third standard deviation, above the third standard deviation, it's 0.1%. So how likely are we to spend time at that third standard deviation? So to flip that on its head, when I'm looking at the chart and I'm looking at VWAP, that's exactly what these are, right? This red line here is the second standard deviation. The green line down here is the second standard deviation, and then the furthest ones out is the third standard deviation. So you can see here, and it's true to word, right? How often did price in today's session spend outside of the third standard deviation? It never, didn't even touch it once. How many times did it touch the second standard deviation? Well, we can count them, right? You can see here, 1, 2, maybe here. And so the way I use it is I'm predominantly looking for a reversal, not just on standard deviation, right? There's a number of other things that have to happen for me, but that's the key, right? So for a scalper, you're looking for an edge, right? A way in which you can be more than 50% sure that you're going to have a higher chance of a reversal than not, right? That's all an edge is. It somehow swings in your favor proportionally than just flipping a coin and saying, right, it's a head or tail. It's either going to go up or it's going to go down. Really, you want something that swings a little bit in your favor. So that I use that as my edge, right? So hopefully that's making sense so far. I'm hoping none of this, I know gets a bit mathy there with the standard deviations, but it's a really important concept specifically for trading, because there's a lot of standard deviations in everything, not just VWAPs, but you'll find standard deviations in a lot of different kind of indicators. So just understanding it's all about probabilities and outliers. How often will these things spend, in these outer quarters? RSI has standard deviations, momentum indicators, they're all based around standard deviation, really, in some sense. So that's the first thing I do. The problem for me is I'm scalping, which means if I'm looking to enter a trade here, let's say I favor this trade, right, and I get in right at the tip of that on the second standard deviation, and price has gone in my favor, $274 on Bitcoin. Now, the problem is, if I'm doing this on Foxify as an example, obviously, number one, I'm paying fees, right? And for that much of a move, if I want to put my weight behind it, I have to leverage up. So if I'm going to go 50x leverage on a small move like that, chances are I probably won't even recover break even in terms of dollar value. Yes, the trade will be in profit in green, but because of the fees, probably not. So I realized, obviously, I'm currently testing out the funded, and I got absolutely battered with that because I hadn't realized at the time that it's much more difficult to trade this way. When you trade with much higher, like if I'm as a bit of an exercise, if I trade with 50k of my own money in funded and I'm using 1x leverage, that would absolutely work fine. There's no problem with that, simply because I'm not going to get killed on fees. But if I'm scalping with high leverage, I am going to get killed on fees. So this, to your question, Robin, was why for me I struggle. However, it's not a lost cause, and I'll explain why as well. So let me just go to the other section of so we can close out this chapter, right? But I need two things to happen. I'm not just going to get in at a reversal, at a standard deviation, right? Because whilst it's a really good opportunity, there's still other things that need to happen for me, and that is all about liquidity, right? It's the second part of the equation. And so I'm going to take off this really quick, and I'm going to bring up this. So what's this showing us? This is showing us those three sessions that I spoke about before. It's showing us Asia, which is orange, showing us London, which is the green, and then it's showing us New York, which is purple. It's showing us the low and the high of that session, right, which is really important. So I want to know where's the high and the low of that session. So you can see here as an example, and this is a really good example for this today actually. You can see that Asia's high is here, and Asia's low is here, right? That's Asia's range today where Bitcoin moves. And I've found recently Asia seems to move the most with Bitcoin. I've noticed a lot. It's the complete opposite in equities. Asia normally consolidates really small, and New York is the one that really expands price. So on that, I just take that off. Let's look at some important factors, right? You can see here where Asia set the high. It's all about liquidity. Look what happens when Asia finishes, which is Asia finishes here, right, which is 10 a.m. UK time. So at this point, if I just draw a line here, now it's about taking the high or the low of the previous session. So when I'm talking about session now, I'm talking about the Asian range, right? It's a really important concept simply because, like, the liquidity here has got all of this move up here, right? All of the move. It's not just one candle that whipped down. It's all of the liquidity that's driven this price is the low there. So you know, if price starts to move down here, you're going to have a lot of people who, number one, who either adding to the losing positions, or they're going to get the stop losses triggered, or even getting liquidated, right? So there's a lot of liquidity on that move up. So that low is a really important part. And the same for the high, right? Look at the high. So the high was created here in Asia. What happens? Price comes up, taps the high, doesn't break it, and then comes back down, right? Now what have we got? Two really important key things. We've got a huge liquidity zone here, right? And we've also got a beautiful liquidity zone here, London's low. And so what happens? It's going to take one of those, right? It's going to take either the high or the low. Now, when I'm talking about getting into a trade, I'm thinking about, number one, do we take liquidity at a session high or low? And are we at an extended version of VWAP? So what I'm saying by that is, right now, I know that this is the zone I'm really interested in, right? Because we've got a double top, got liquidity because this is the height of Asia. And then London came and didn't take the high of Asia. So we've got two big areas where liquidity is being built. And now we're waiting for the next activity. So here's what happens, right? Let's see what happens if I put on my... So that would have been an absolute perfect trade. Why? Because two things have happened. My two perfect golden rules are, we've taken the liquidity above Asia and above London. So we've taken two session highs, Asia and London, and then we've hit exactly perfectly the second standard deviation. Now, the reason I'm saying it's probably still a valid trade is because that is you can certainly make money on that on Foxify for sure, right? If I'm 50x, $100 on that, I imagine that that's going to be a really nice move, right? So that is how I trade. That is all I'm looking for. Have we taken a high or a low of a important key session? Asia, London, New York. And then after that, and only after that, are we taking are we at an exhausted position? Second standard deviation, even more better, is the third standard deviation, because again, for that reason that I said, it does not spend an awful lot of time there. Usually it's going to get hit with some sort of resistance, and if it's to the buy side, down to the bottom, it's going to be hit with a load of support, right? So firstly, just to make sure I've not lost anyone, is everyone fully understanding what I'm talking about? Do we need any clarity on liquidity? Why it's important, like how I understood these zones, why these two zones specifically? Because it's a really fundamental thing to understand, and this isn't ICT bollocks or anything to do with someone's system. This is just an understanding of how markets drive towards where pools of liquidity are. because bigger moves are usually happening, right? You know, this zone here of liquidity, in my opinion, based on what I'm looking at here, there's a higher potential that price might start to drop because they've used this as a fueling mechanism to drop down and take the liquidity for London. So where's London's session? So London is here, right? This line here is London's low. So usually what New York likes to do is take the high of a session and then take the low of a session. It doesn't always happen, but it's a possibility, right? Because it's always fighting for where the biggest pools of liquidity are. Does that make sense? Just drop a note in the comments box or something, just that you're it's all sinking in quite nicely.
Yeah, for me, it all makes perfect sense.
Good. So that's really key. Just understanding, you know, I'm looking for two key things to happen. We take liquidity out of session, and we take we're at an over exaggerated point on the chart, whether that's you know, second or third standard deviation. Perfect. Okay, so that was essentially a recap of the first session, if anyone missed it, right? So the reason this works so well, by the way, is because, you know, it's not a silver bullet, it's not perfect, right? So, you know, don't just jump on the chart, wait for it to hit a really high point and then go, right, I'm going to reverse this, because I've seen these absolutely rip. Like a huge big news event, doesn't matter what, you know, whether it's second or third standard deviation, I have seen these continue to be driven. So you've always got to pay attention to big news events, right? Which it's a reason why I don't like trading Bitcoin, because Bitcoin is 24/7. It can react anytime it needs to. Equity's different. Once London's finished, London's finished. Once New York's finished, New York's finished. Once Asia's finished, Asia's finished. So there's only ever a certain amount of markets open on equities. You never get the full picture, like the biggest zone. So you might ask, well, what are these boxes here? These boxes are essentially what they call kill zones. These are the where liquidity gets injected into the market effectively. So it's where you normally see the biggest swings occurring during the kill zone, and you can see here quite clearly in Asia, right, big swing, right, huge amount of liquidity comes in, you know, relative to its position. You can see here we tapped the third standard deviation, came off a little bit, come to the second standard deviation, sold off. Where do we go? Right into the VWAP, comes back up again, retested the VWAP, comes up, second standard deviation, so on and so forth. So this is just a nice tool to kind of see the variance between the different elements of the standard deviations, but these kill zones usually are where liquidity gets pumped into the market. So just in case anyone had a question on that. So the other thing, so all in the theme of importance of liquidity. So just to take a pause, if I was to say to you now, where are you going to find the biggest liquidity pools in any chart? Right, it's always going to be from top down, previous day high, previous day low. I'm going to show you something. So what you're looking at now, I know it's not easiest to see, but these here, these are all, I'll just zoom out, I'll go to the 1 hour. The lines you're seeing here doesn't work very well on perpetuals, unfortunately, but this is previous week's high. So that orange line there, this is this week's high, just slightly underneath it. This is previous day high, so yesterday's high. This is yesterday's low, and this is the weekly low here. Apologies if this isn't perfectly clear. I have my charts quite zoomed in, but if I just show you, you can see these lines. These are usually always on in the background, because what I'm looking for is where's the liquidity. Like, I want a framework. If I'm gonna start trading, the first thing I want to know, I want to be able to build a picture quite quickly on whatever instrument it is, whether it's any cryptocurrency, whether it's equity like Nasdaq or S&P, whatever I'm on. I want to be able to quickly build a picture to say, right, where's yesterday's high, where's yesterday's low, where's this week's high, this week's low, and then quite quickly, you know, right, where are we relative to that? Are we even close to any of those areas? Because that's a high chance that we're going to probably go and take previous day high. So this was, if I take my screen back to here, right, this is what we would have been presented with. Okay, you can see, you can actually see, so think market would have started here. If I just go back a bit further on, sorry. Let's go here. So you can see the range there, right? That was previous day's high and that was previous day's low. I would say 90% likelihood you're going to take a previous day high or a previous day low every single day, right? I haven't even fact checked that. I just know because that's a high liquidity zone, right? If I just forward this a few bars, press play, right? You can see we took out the low, previous day's low, and then where did we go? Straight up to take out the previous day's high. I hadn't like orchestrated that. I'm just showing you exactly what tends to happen, how price moves. It's always looking for those liquidity pools. So from top to bottom, most important thing you want to look at is previous day high or low. They're usually the biggest liquidity pools. Next line down from that is the session high. Session is Asia, session is London, session is New York. Where are those highs and lows? And so they're more like intraday, right? Looking at where Asia started. Okay, where's Asia's high and low? Is London going to take out one of them zones? If not, where's New York? When New York kicks in at 2:30 UK time, is it going to go and take out one of those positions? Always keep your mind looking for that. So when you're on the chart and you're looking at the price action, there's a very good likelihood. Okay, where's price likely to going to go to? It's always going to help you out in terms of navigating the chart, right? And just bring this back to play. You can just see like it's taking out the highs and lows each time, and then we are where we are. So I have that one on. So I'm looking at the highs and lows, looking at the session highs, I'm looking at VWAP. The other thing I like to look at, and I think this is a really important one, is don't have it on. Let me just open something up really quick. So this is called the, oh, not that one. TV session. Just give me 1 sec, I can't remember which one it was, but you do need to see this really quick, right? Reload without saving. There, what's that called? Yeah, PVP, right? Yeah. Okay. Yeah. I'll just quickly change this to what I like to see. I want it on the right hand side. This is great, this one, by the way. Have it on the right. I don't want the box on because that's horrible. Do want them. Values, PLC. Let's just change these to grey, 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 grey. So this is the session for the week, right? And so what you'll find when you're looking at the weekly session profile, it's where, well, you've got a value area high, a value area low. These are these blue lines here. And then you've got the point of control where essentially most volume's being traded for that week. Now, you can do this daily, you can do this whatever time frame you want. I would recommend doing it on the session for the week, because I find price often magnetizes across the value area low and the value area high. I mean, you can see here just for this week alone how well it's been respected, right? I mean, if you're longing each time price comes down to the value area low, bang, you're in a good spot, right? If you're going to short each time you're at the value area high, you're in a good spot. Eventually, of course, we do break out. But what I always see is, if we had a big sell-off Monday, Tuesday, whatever, there's a high likelihood that you're going to come back and revisit that point of control sometime during that week. It's not always, but it's a good indicator. Normally you'll get a big expansive move, and then during the end of the week it will eventually try to come back to that point of control, simply because liquidity, it's where most liquidity is traded. It's where a lot of big institutions like to get the price towards, simply because they're moving orders of magnitude of the type of capital that we're moving, right? So for them, it's always about where's the highest amount of liquidity, which is why essentially why I'm telling you about things like the previous day highs and lows, session highs and lows, because they're the places where institutions, you know, BTC's got heavily backed by ETFs now, right? So you're going to have big money moving and exchanging hands. These are the zones where you're always going to see price drive towards. So this specifically is what I like to just have. I don't always have it on a chart, but I like to have it on in the background just to give you a sense on where things are relative to the price. Everyone going all right? I'm kind of keeping the pace moving enough. Anything I've not covered or I'm covering too quickly, just let me know if you need me to drop it down a little bit. That's PvP. Right, so that's in a nutshell what I wanted to cover. Now, for all the Foxify traders, I want to show you something that I think is really important and for you to have, so you understand, right? I trade mainly with volume indicators. You've just seen that PvP. That's a volume indicator, right? Because you've got volume there. It's showing you where the highest amount of volume is being traded that week. You've got the VWAP with standard deviations. That's a volume indicator. If you can't track volume, it's not going to show you that status, right? That's not a volume indicator. That wouldn't have a problem. What else have I got? A few other bits and pieces that aren't relevant at this time. Pith doesn't allow you to trade volume. I think we all know that, right? When I say it doesn't allow you, it doesn't track the volume. And so if I was to just have a, let's say I go here and go, let's just bring another chart up really quickly, right? I'll just go clean chart structure. And I change this BTC, sorry, PYTH, BTC USD. You can see the colors are all grey. I have no volume underneath here. I have no CVD. It's just all grey. It's because it doesn't track volume. And I don't know if Kick's watching. Kick can probably be able to explain this better, but there's some reason. I think because Pith aggregates a lot of different exchanges, right? So I think it's difficult to track volume. But that's not great if you want to trade Pith, because if you're trading Pith with Foxify and you're not being able to use volume indicators, that's a problem. So here's the solution. You'll see here, right? I've got the colors. I'm using, it doesn't matter what Bitcoin chart you're using. You could be using MEXC, you could be using Bybit, you could be using Binance, you could be using whatever. It doesn't really matter. But I've added this element here. Now what you'll see is this line. I'll have to zoom right in. But the line is Pith's price here. So Pith, you'll notice, is about $60 out from MEXC. The blue line you can see moving up and down, and the grey line is essentially one's Pith's price and one's MEXC's price. Now, if I want to short, let's say when the price comes up to here, I want to know where Pith's price is relative to that volume point, not MEXC's. But if I don't have MEXC and if I don't use MEXC, I'm not able to provide the volume, right? So the way you get around that is on your chart. If you just hit the little plus symbol here, let me just add a bit more. If you hit the plus symbol, type in PYTH : BTC USD, and then when you hover over it, you want to select same percentage scale. When you do that, it's going to add Pith's line in, right? Then what you want to do is just right click in the scale, and instead of percent, just choose regular. What that will give you, now you can see Pith's candles overlaid on MEXC's candles. I think that looks disgusting, right? So I'm not going to show us that. I'm going to show it as a line. So I just changed that to line, and boom, you've got Pith overlaid on top of MEXC or whatever you want to show it on. Just means that it allows you to use Pitt's price without using losing the volume indicators. So that's a nice little one for you for free. Now, did I cover that too fast? Does anyone want me to go over that again, or are you happy with that?
Yeah, if you could do it one more time, because it was a bit quick.
So, let me just talk about the problem. The problem, right? Foxify uses Pith, right? Now, chances are you're probably using TradingView for your analysis before you enter a trade, right? Because you've got a lot more accessible tools than what you will have on any typical trading platform, right? So you want to use TradingView for your trading. The trouble is, if I just put Pith on my screen, Pith's price is some way off from central exchanges, right? Maybe up to $100 in some instances. Now that's a big delta between the indicators you're looking at and the price of Pith. So, it's important that wherever Pitt's price is, it's relative to wherever you want to get in. If you're using indicators, specifically if you're trading the way I trade, which is on looking at volume indicators, it's important that you know where they are, right? So just to recap, to add Pith to your chart, on my chart right now, I'm just trading MEXC. You can see all of these coins here, they're all from MEXC's charts. When I was trading crypto back in the day, I was just using MEXC, right? But there are others, of course. But to add Pith, the Pith price, you just simply go to the little plus symbol in this top left hand corner next to where it says BTC USDT. You'll see a little plus. This is where you can just add another price. So if you hit plus, and then you should see something that says compare symbol. If you just type in PYTH : which is the 2 dots, and then BTC USD, what you'll have is, it should say BTC USD. That's Pitt's price for BTC, right? And then if you hover over it, you've got 3 options. You've got same percentage scale, new price scale, or new pane. You want to just add it as a new percentage scale, and it's going to come up with a, it's going to add it in, but it's going to overlay Pitt's candles, which are the red and green ones, right? You can just about see them. If I just where are we? I can't minimize it, but you can see that the candles overlaid on top, and there's a big difference, right? There's sometimes one more step, sorry, to right click in the percentage scale and just change it to regular. Well, you look at the difference in the Pitt price, right? The blue line is the central exchange, which is currently at 66,590, and then Pitt's price is 66,640. So that's about a $70 delta between Pitt's price and a typical central exchange, right? Now they're always going to vary. That's not a negative, by the way. But for trading, it is, right? If you're trying to get in at a specific position and you're using volume, well, you need to know where Pitt's price is relative to wherever that indicator is. So it's an important thing, I think, to be able to add Pitt's price. Now, I wouldn't have it as a bar chart. I would have it as a line graph. So to change that, if you just double click on Pith, if you just double click on the actual candles, you can just change that to line, right? And that looks a little bit neater now. So I can say I've got 2 price lines on here. I've got my MEXC's price of Bitcoin, and I've got Pitt's price. So the reason that's important is as this light blue line starts creeping ever closer to an area of value somewhere that I'm interested in trading, I know where Pitt's price is relative to that indicator. Of course, the volume for that indicator is being derived from MEXC, but it's neither here nor there. I'm comfortable with that, right? I don't mind being a few dollars out. I just want to know where Pitt's price is, though. It's an important point. So, did that make you look at Harley? Hi, hello. Scouser.
Yeah, I got it as well now.
Okay, so that's how you add Pith, yeah?
You're using just Pith USDT, right? Not Pith USDT.p, because I've been using USDT.p for everything so far.
Well, let me
as it's the perpetual one.
I don't think Pith has P though, does it?
It does. It does. It does. That's why
does?
I'm asking.
Ah,
Yeah. It has.
hang on. Pith USDT. That's spot, isn't it? So where's?
I've got it.
Sorry, BTC. My bad. BTC. .p is it?
Maybe I put the wrong one in there.
USDT. No, BTC.
I think I've got BithUSDT.p. That's probably the wrong one then, right? That's
Yeah,
probably
no, it needs
just
to
for
be.
the protocol.
It needs
Yeah.
to be BTC USD. I don't think there's a. Unless someone tells me differently, I don't think. That it's just spot rates. It's so it's tracking BTC or spot BTC. Maybe you can get Danny to fact check that because I'm not 100% certain, to be honest with you. But there's Kick coming in with some comments, so maybe you can answer that. Let me just see what Kevin says. I must add, by the way, it was Kevin who showed me this, so props to him on this. By the way, I'm not hogging the limelight on that.
Yeah, I think you're right, Kick. I was indeed using just the Bith.
Yeah.
So the price of Bith instead of the Bith Bitcoin one. Yeah.
The key takeaway here though is just to be mindful that if you're trading Pith ultimately, and there's a delta between what you'll see on if you pick any chart like MEXC or Binance or whatever chart you pick to trade on. You can just use Pith charts, but you're not going to have the benefit of using any indicator that has volume. That's the problem, right? So this is kind of a fudged workaround to allow you to use both Pith as a price, as the line, as how I use it, and the your volume indicators. So that's what I would say on that. Right. Okay. So what are we on to now? So I kind of covered a lot of the recap from the first session, right? So what do we want to cover now, Frida? What's next on the agenda?
Yeah, one sec. Let me go quickly have a look. Because I have so many tabs open. I'll just go here and I'll be able to tell you. So that was the price action trading.
So price action trading. So there's lots of different styles of trading, right? People trade with indicators and they're waiting for a buy or a sell signal, or it's when RSI hits 20 I'm going to long, when RSI hits 80 I'm going to short, overbought, oversold, stuff like that. That's a very traditional way of trading, right? Just using indicators to derive your response to how you trade on a chart. But price action is a bit different, right? Price action is getting really deep and familiar with how things like volume and this notion of absorption, where you see price come to a certain zone and you see things happening but price doesn't move back or whatever. It's a whole thing, right? It's looking at price, pure naked candle trading, not really relying on indicators to derive where you should be thinking about getting in. I'm going to try to articulate that a little bit better, right? But you can clearly see here, this is all much higher volume, right? But interestingly enough, the candles don't represent sometimes the difference in volume, right? So it's called volume spread analysis, but basically it's this idea where you kind of see, if you didn't have any picture of volume at all, let me just say, if we had no volume visibility and all we were looking at is candles, right? We don't know an awful lot other than this candle was higher than that candle, that candle is higher than that candle, so on and so forth. It just gives you a representation of the price action. But volume speaks so much more than that, right? Volume is a much, much deeper knowledge to what is actually happening, because you can get, let's say, a real tug of war, right? Price comes into a certain point, let's say price hits $60,000 BTC, and for whatever reason, we have the bulls and the bears really going at it. One's trying to short and one's trying to long expecting a breakout of 60k, short because they expect a reversal at 60k. And sometimes that can mean that the size of volume in the candle is really going higher and higher and higher, but the reality or the relative movement of that candle tells a completely different story. And so when I'm saying about the colors of these candles, it's representative purely upon a number of factors. Actually, number one is how big that candle moves relative to volume. And so let me give you an example here. Like, look how big this blue candle is here, right? This blue candle's let me just expand that out a bit, right? Would you say that this blue candle was bigger than this red candle? Frida, I'm waiting for you to come in.
Oh, sorry. Yes.
You would agree?
Yeah. Yes. Yes. It is much bigger than.
Look how much volume it took to move that candle versus the amount of volume here in this candle.
Wow.
I mean, try to articulate what you think that means, or what could be happening there.
A lot less volume was required to move it up.
Yeah.
In the second part.
That could be buyers are stepping away.
Mm-hmm.
The order book has become a lot thinner, maybe because the move down has cleared a lot of that order book. I mean, these are minute by minute candles, so I would very much doubt it would be that. But it could exactly be that, right? That's exactly what you've got to be thinking. Wow, it hasn't taken a lot of volume to create such a big move. Now that's gone from 64,600 to 65,000. So that's moved $600 in 1 minute on that volume. And so just to give a sense on the colors, the blue, if you see a blue candle, what that represents is big candle, low volume, right? So it gives you an indication that something's changed, right? The mindset or the characteristics of Bitcoin at that price, something has changed, right? It's not relative to its last 10 previous candles. These colors and the calculations that sit behind them are always relative to the last 10 candles, right? So dependent upon how much tick volumes come into a specific candle versus its relative size will give you an indication of what's going on. I mean, price action's really key though. So like, not just figuring stuff out. So you can clearly see, like, as price comes down here, again, look at the relative volume here, really low volume. Price is in accordance with that. So price is in agreement with volume during these moves here. But then both volume and price are in agreement here. So it's a good way to phrase it, actually. Where you see red candles and red volume, price is in agreement relative to the candle. So price is moving proportionate to the amount of volume that's coming in. Does that make sense? Like, a lot of volume's coming in at that time, and price is respected that by moving, that distance. So that's like... Sorry, this is just looking at Kick's conversation. I hope that makes sense. So let me just try to reiterate that. If you get a big amount of volume coming into the market, right, with the price respecting that. So what I mean by that is, you can see here, right, length of candle, nice big long candle, 400 points, nice big red volume. That means a lot of volumes come in, but it's also being respected in the way the price has moved. So that's absolutely no problem with that at all. Where it gets really, really funky is, let me try and find one that's a bit more obvious, is here, right? Orange for me is usually absorption. That's where, do you remember when I spoke about the difference between market orders and limit orders? So a market order is a taker, basically. A market maker. They're people who are actively, aggressively just buying at the current price. Whereas, a limit order is sorry, no, I got that wrong. A market taker is an aggressive buyer or a seller, someone who's just taking at whatever the market's offering them at that given time. Whereas a market maker is a limit order, so somewhere they've put a price in. But if you can get enough limit orders on an order book, that can give you enough it doesn't matter how much aggression comes in, it's just getting soaked up. That's really what that orange represents. So what I mean by that is you can see here, and the response really confounded that. Let me explain this, because if you understand this, right, I will be so pleased, right? And that goes for everyone who's watching. If you can understand this, I'll be super pleased. Look here. See the volume here? These two candles. Frito, unfortunately, as the host, I'm going to put you up on. I'm going to put you on the spot here, right?
Yep. I'm here.
Right. What's price been doing from? Let's see, from this point here.
Yeah,
where's it
dropping.
been going? It's been dropping, right?
Down.
What does it do? It gets to this candle. We haven't, in relative sense, volume's been pretty low, right? Then we have this nice big candle here, okay, signifying that we're getting a bit of a drop. Price continues to drop, low volume. I'm always really nervous when I see big moves with low volume, right? It's like, is this the real move? When you don't see volume backed up with, so if you see big candles dropping and the volume's low, always be cautious, right? That's a good clue as an indicator that actually this is a manipulated move, right? Because there's no volume there that's driving the move down. So you've always got to be careful, right? So anyway, prices continuing to come down. Comes to this point, look how much volume comes in there. It's as big as that. This volume candle. Look at the candle though. It's spinning top, right? It just comes up, comes down, and finishes slightly lower. Then the bears go, right, we're going to have another go. Big volume comes in the market again. What happens? Completely rejected again. Then what happens? Third candle, bang. Big move to the upside. Big volume. Then what happens? The bears are still trying to short it, but the candle size is small, way smaller proportionally than the volume. Volume's still relatively high, but the candle sizes are still way shorter. So that tells you, right, on an order book, like, you imagine it's like a wall of limit orders, right, where people are aggressively trying to sell short, but because the limit orders, let's say I had 20,000 Bitcoin of limit orders, right, people just resting their orders here at this current level. And then you've got market orders trying to push the price down, trying to buy up, or trying to sell into them orders. It's eventually it gets exhausted, right? It gets to the point where you run out of steam. There's no more sellers to keep selling beyond that point. And so what happens? Price reverses, right? Really nice move back up again to the upside. It's why, like, for price action, it's key to understand those two concepts: volume in relation to price. And it's not a perfect science, right? It's not to say, okay, we've just seen a series of orange candles, therefore we expect price to go back up. It's always about the here and the now, right? Because we don't know at this stage whether the guys who are backing up this wall of orders here are going to sustain the aggressive orders that are trying to push the price down. It can still happen, but it's a bet I'd always be willing to take, right? If I see a number of these failures where it's failing to break a level, you get a little wick here, and then, price expands back to the opposite side. It's a risk I could take with risk management, right? You're always looking for areas or interesting areas on the chart where to get into a trade. So in a nutshell, that is price analysis or price action. It's using data, volume and price to determine what's going on behind the candle, trying to imagine what's going on behind the candle. We could talk about order flow, we could talk about depth of market. I'm not going to do that on this. Number one, I haven't got depth of market on this current trading view, which is essentially the order book, right? And I don't have order flow, which shows you exactly where the auction's happening at a candle by candle level. That's way beyond this this training session for today, but something worth understanding. So does that make sense?
Yeah.
Just, look, you're not going to understand this straight away, right? But and a lot of it might go over your head, but it's really important to have some sort of level of understanding of what's going on. Like, if I turn this off, Sorry, it's here, right? Like, look at the difference here now, right? Like, what does that what does that tell you without those colours? Right?
It'll just tell you where price is going, right?
Well, it's. I mean,
You don't have any volume.
how can I make any rational decision now? I've got no volume, and
Yeah.
I've got nothing that's giving me any indication of what's going on. So, you know, this volume suite, it's such a powerful tool, right? Now, like at a glance, I can see, okay, orange, that usually indicates at least some level of absorption. You know, a lot of volume coming into the market, but the price isn't moving an awful lot. Something's happening there. There's a big tug of war going on, or, you know, we're hitting a point where price doesn't want to go any further, so there's a good chance of a reversal. I'll touch on this really quickly, right? Because it's a complex subject in my opinion. But this is called CVD. We're going advanced here, guys, right? So I hope you're okay with this. But this is cumulative volume delta. What it's basically telling us is purely market participants. So market takers, right? So people who are literally buying at the order book, or, you know, not limit orders, not like, you know, I'll place an order in the order book and I'll wait for my price to come in. It's purely aggressive orders. So a really good indicator, again, similarly to volume, is understanding what's going on the order book in terms of market orders, because ultimately, if there was no one to place a market order, price would never move. You know, you could have limit orders resting in the order book all over the place, but if no one goes, right, I'm going to buy now at market, price would never move. It's the market makers that drive price, right? So the market takers that drive price. If you don't have people who are willing to buy at market, price won't move, right? And so this, again, like, if you're looking here, let's see if we can kind of figure out what's going on here, right? So you can see at this stage, price is trying to move down, right? You've got two orange candles, but if you look at the CVD, which is the cumulative volume delta, what it's showing us is that even though price is moving down, aggressors, as in market orders, are trying to push the price up. So that's a bit of a divergence in what you're seeing from the candles versus what you're actually seeing in terms of the market, right? So market's trying to push up, which is why we're getting these green candles here to show us, and then you get this really big volume here. So like if I was to just draw this and go, let's say from where's that one there? There's the high of that to the high of that. Right, I'm moving up here, right? But if you look here, from that same point, I'm moving down, right? So that means market participants were very aggressive. Then we got a bit of a sell-off, and then we come to this point and sold off again. But in terms of the price done the opposite. Price actually pushed up, right? So even though price was trying to get pushed down, right, it tells us that this whole zone is very much being absorbed, right? Because even though, like, look at this big aggressive sell-off here, huge amount of people trying to push the price down. Yes, price pushed down, but not significantly enough. In fact, what it did do is just push back up again. So that's kind of a clue. So you're looking to say, right, lots of aggression coming into the market, because you can see purely that market's trying to push down, but you only got this little small wick of a candle before price actually reversed, and there's actually another divergence there. So if you take that low to there, that's relatively straight, whereas this one goes from here to here. So that one's kind of bearish in terms of its push. So if you're seeing, the takeaway here is, if you're seeing bearish activity in terms of CVD, meaning people are trying to push the price down but the price is not respecting that, then that tells you one very clear message, right? And that clear message is it's being absorbed. You've got limit orders on the book that the buyers are trying, or the sellers are trying to hit into, but the price isn't moving. It's an eye concept. It's not. I realize as I'm saying this, it sounds confusing, right? But the important thing to understand is, like, if you can picture an order book. On an order book, you can see you have all the different price levels with all the different amounts of liquidity sitting in that book. That's all resting liquidity. You've got to rely on market orders to come in and soak up, buy or sell that liquidity in order for price to move. And so that's what it's really all about, right? Aggressors trying to push the price down, limit orders absorbing it, price then expands into the next one. Took me a long time to figure CVD out. It's not an easy concept. It becomes easy if you understand an order book. If you understand an order book, then you're in good spot, because you understand the difference between an aggressor and kind of a passive order in an order book. Then CVD becomes a whole lot simpler, because all this is a representation of those market orders relative to the price action. What's next, Frido?
Yeah, I think you covered a couple of things already. So
Yeah.
we had the price action trading. We had the importance of volume, which you already nailed.
Yeah.
Next thing is, how do we spot traps? Well, you did already, but yeah, dive into that as well, right?
So, a trap. Like, here's a classic trap, right? You can see here, a lot of volume comes in. You can see here. Now, if you're longing, like here, you're in trouble, right? So you can see this kind of move really started at the initiation, right? A lot of kind of tick volume came in, it's green. Price comes down a little bit, but then price continues up. And what tends to happen for every retail trader, I've done it, you've done it, Kevin's definitely done it millions of times. I know Kevin's been caught in traps a million times, right? But what happens is, you jump in at the end, right? You think price is going to moon, and then you get caught here, right? So can you imagine, always put yourself in two positions, right? Who's it going to hurt more? Like, when price is coming up to this top, you've got a decision to make. Am I going to long or am I going to short? And who's it going to benefit most? Usually what happens is this, right? Here's the high. This would have been the natural liquidity level, right? So liquidity's been taken, right? You can see it here. We've peaked above, liquidity's been taken. What a lot of people get wrong, though, is they think it's ready for Moon City, and so they continue buying in here. Now, can you imagine if you've bought in at this point here, right? You've bought in right at the top there. What happens now when price is down here? Maybe you'll try to average down, so you'll buy in again. Okay, so now you've bought in a second time going long at this level here. Price goes against you again, so you'll buy in again. So now your three orders in, you're getting quite high to your liquidation level already, because you've got caught in a trap. That's effectively what a trap is, right? And this is pure manipulation, because it's exactly what the market knows. There's going to be people like me, you, and everyone else who's a retail trader who just gets caught out, right? They think price is going to go up, and it's not. There's nothing wrong with that. It just happens, right? You get kidded into a false sense that price is going to moon, when actually what it's doing is building up orders at the high, because that's where it got rejected last time, and then just doing a little liquidity grab, trapping traders into putting more money into the pot, when realistically it was used purely as a fueling mechanism for price to go down. Now, I mean, look, price did eventually go down, right? It kind of hung around again, but again, this is that horrible feeling, right? So you've entered here, you're short, you're long, sorry, and then price comes up to here, and you're thinking, yes, price is going to retrace, it's going to come back into my zone, I'm going to get out at break even. It doesn't, right? And it's that heartache of the feeling where price just keeps going against you, and then effectively, if you're 100x leverage there, you're out, aren't you? You're in the mud, basically. So that is a trap, right? And then, where you tend to find it is on them big moves. I find the best, like, normally when you see a level first getting created, it doesn't tend to take it on its first go. Usually what you find is when candles are getting smaller and smaller and really getting close to a specific level, and there's a lot of liquidity building up, then you seem to get a bigger punch through, right, with a continuation. What in my experience, just as a kind of pure experience-based statement, is if you have a price level and then you see a big move that starts way below that price and then goes just above that level, it's usually a big wick or a big liquidity grab, and they are less convincing to me than what it would be if price, you start building very, very small candles up to the point where the higher level is, like this liquidity level, and then it breaks through. Like you can see, big candles breaking through, and then we get that rejection. This would have been the next level, right? So here's your new high. Nice little double top, right? So that's built 2 levels of liquidity. So you can think there, right? All of the liquidity that was built up here to this point. Then you've got another nice liquidity pot here. So this is nice liquidity zone here, right? But you can see here candles building up and building up and building up and building up, and then the price just closes just below there. A lot of momentum to push through at that point then. And then you get a small retracement and then the continuation. It's not an exact science, by the way. I'm not trying to say this is the way you should look at it, but I think what I've found, what's really helped me out in trading, is just understanding liquidity, where the levels are, what's important, what's not, understanding the relative volume. Those things are kind of key in price action trading. Now, obviously, price action is something I use, but I have a very kind of key set of rules now that I look for, which is those high levels of volume, liquidity pools, session highs, previous day highs, lows, and taking, a level where I'm confident in terms of your expanded data points. I mean, you've got it there again, right? Look, nice rejection again. We're on the 5 minute here, but nice rejection. Where could we head to? Potentially a nice little bounce off VWAP for another move up. So they're traps, basically. Just understanding that traps are there designed specifically to make you expect a move to the upside. And where you see a trap, most likely is like the best, like I would say, like this kind of activity here is a classic trap, right? Big candle up and then a huge big candle straight back down again. These guys are in pain, right? If you're long in here, they're in pain. If you see a big candle going up and a big candle coming straight back down, that's a trap. Every single time it's a trap. Trying to find some other good examples. Nice little trap here, right? Big candle push down, and then 2 big candles that basically usurp that one there. Another trap. Guys are in pain if you've been short on here. You're not to know that though. That's the challenge, right? You don't know when you're in a trap. But what you should be anticipating is if you are in a trap and you're in a trap, don't hold on to the trade. Chances are that trap is designed specifically to get you liquidated, in my opinion. What's next for you though?
I think there's only one thing left, because you've already covered the overview of the cumulative volume delta, the CVD.
Yeah.
The only thing left is exhaustion.
Exhaustion. Okay, well, exhaustion is actually exactly what I showed, right? Which is identifying those areas on the chart where you expect a reversal. And that is effectively, for me anyway, standard deviations. They're the points that was kind of that standard deviation. So when you're hitting like a third standard deviation as an example, or a really expanded ATR, they're the ones where it's all about probability, but you expect some level of a rejection from there. The other thing I want to just show you is, because I think it's really important, and I hope Kevin won't mind me showing you this, but this was an indicator that Kevin built. which is phenomenal. There are certain indicators, right, which takes away the guesswork in the sense of, like, for me and you, Frido, right, me and you may look at a chart and we may have, if we're purely looking at how prices react to certain levels, we may have completely different ideas on what you would class as support level as to what I might class as support level or a resistance level, simply because it's arbitrary, right? We're two different people with two different concepts, therefore your levels are going to be different to my levels, which leaves a lot of indifference in people's opinions, right? So there's a lot of room for error, right? You may be wrong, I may be wrong, it doesn't really matter. It's just based on where you think a level of support would be compared to me. You may get in slightly earlier than me, I may get in slightly later. That may benefit you, it may not benefit me. But the two things that I like to use, which is absolutely ironclad, and it would be the same on my laptop as it would be the same on your laptop, as the same on, you know, Carlo's laptop, it doesn't really matter, is indicators that's ubiquitous throughout. And that is, as an example, and there are variations to this, so it's not cast iron, but if I look at, like, if I put that on the chart, that level, that's their standard deviation, is the same level for me as it is exactly for you, which is why you see an awful lot of reaction always when it comes into those points, because it's the same level for everyone. If you put that on your chart, you're going to see that exact same level as what I see. So do you understand what I'm saying? It's not open to arbitration. You're going to see the exact same level on your chart as my chart. Whereas if I go, actually, do you know what? I might just, you know, I'm going to say that actually, you know, I think, you know, if I go to like the 30-minute, you know, that this is a zone, you know, that's a level where I'm interested in. You know, this is a zone where I expect to get a rejection. But you might say, well, actually, I don't think it is. You know, that's
this is your own interpretation, right?
Exactly right. It's the own interpretation. Here's a phenomenal indicator that I've been using for years, but I've been using Kevin's one since he created something that I think is really, really good. It's called the range ruler, but it's a take on pivot points, right? So what you're looking at here when it loads up is the same for everyone, right? These are natural support and resistance areas on a chart, right? So you have the pivot point, right, which its calculation is a very simple one. It takes yesterday's daily range, the open, the close, sorry, the high, the low, and the close, right? Or is the high, the low, and the open, Kev? You might be able to. I think it's the high, the low, and the close, and divides it by 3, right? So if I go on a daily candle as an example, okay, you can see yesterday's high was here, yesterday's low was here, and then its close was there. So if I take them 3 prices, 65, 7, 11, whatever that one is and whatever that is, and divide it by 3, that will give me the next day's pivot point. So that blue line you see in there, if I just zoom in, the blue line is the pivot point, right? That's the market's yesterday's daily range pivot point. So that's a really key concept, where similarly to the likes of the price action that you're seeing with the volume profile for the value area high, the value area low, and then the point of control, the pivot point is the same for everyone, and it's the same on everyone's chart. Like, you can see just how much respect these zones get, right? So you can see here, this is the start of the session, at this very start here. Price opens, smashes through the pivot point, and you can see comes right to S1, which is support level 1. Then where does it go? Right to support level 2, gets a rejection. Where does it hold its support level from? S1, right? Support level 1. Then it eventually gets, you know, has another attempt at R2, sorry, resistance R1, resistance R2, resistance R3. These are the 3 levels. I think they go up to 4, right? So usually what that's to say is you don't expect price to go beyond 4 pivot ranges in a session. So just as another way to kind of think about areas of interest, right? That's another fantastic area of interest there, right? To understand that price usually respects your pivot range levels, and it's the same for everyone on everybody's chart. Does that make sense?
Yeah. How was this called again?
So this is one you can get the standard one on TradingView. This is a I think it's a paid indicator that Kevin I think you get it as a VIP member in my server. Shameless little plug there. But you know, it's one that he's developed. You can get, there is one on TradingView. That's their free indicator that you can absolutely use as well, which does the same thing effectively. This one has a lot more elements to it though. It also has things like ATR levels, as well as they're shown as compressed. This purple one I love, because this is effectively looking at the standard deviation of price, right? So how much price moves over the last 21 days to show you where, you know, that standard deviation. So I'm just going to show you this really quickly again. That's the standard deviation, right? So the likelihood of where price is going to go. Again, we're diving into the real depth of waters here, but like you can see here, that's 0.5. That's 0.5. So what that says is during the session, the likelihood that Bitcoin's price stays inside this area is like 68%, right? Oh, sorry, no, it's there. So the likelihood that between the start of the session and the end of the session, where Bitcoin's price will close, there's a 68% chance that it's going to be within this zone, right? Within 2 standard deviations, there is a, let me just check that.
Yeah, 68 plus 27, right?
Yeah, there's a 27% chance that price ends up here, and that's also the same, by the way. Sorry, it's a really good. I love this indicator, right? There's the second one, and then there's a 0.1% chance that it ends up kind of here, right, up to this level, that it closes and finishes its session in these levels here. So the way it's done that is it's taken the last 21 days worth of price action to derive where the standard deviation of the price is expected within these. So this is 1 standard deviation, this is 2 standard deviations, this is 3 standard deviations. That's 1 standard deviation, 2 standard deviations, 3 standard deviations. So there's a lot going on there, but it's a really good indicator to show you where you expect price to be. So the likelihood, the biggest expansion is that it's going to stay within this price somewhere, right? So close of play. We've only got a few more moments left of the session. You know, it's going to probably land here. So you can use that as a way to think, right, well, the moment that when price starts to really expand beyond 2 and 3 standard deviations, there's a really good likelihood that you're going to short, right? In with your VWAP 3rd standard deviation. This is where confluence really comes into play, because you can overlay these things as confluence to say, well, actually, if I'm out by X amount of standard deviations on my price action relative to the last 21 days, and also I'm at the 3rd standard deviation on my well, where would that be actually? Just very quickly. So I go. Now you can see here the 3rd standard deviation on the VWAP is also at the 2nd standard deviation for the price action. You can get really wild with these things, right?
That's crazy.
Overly zealous, but like it's all to give you a bit of an edge in the market, which you'll find a lot of people won't go to this length, right? It's like it's yeah, you've got to be a little bit crazy, right? If you like this kind of thing, which I am slightly odd. I think.
Aren't we all, Andrew?
Yeah. I'm going to reserve this time for any Q&A. If there's anyone's got any questions at all on anything
Sorry
we've
about that.
discussed, I'm more than happy to answer any questions. I mean, is anyone even stuck around?
There's only 4 people left.
It's all
I only
legends.
just saw.
It's all the legends anyway.
Yes.
So
Big Mouse, Sucker, and Elva.
I only, you know, I know there's a lot of information there, right? And it's like a lot of that, you know, I've garnered over years, you know, of trading and different things and stuff like that. So, you know, if there's anything that's not explicitly stuck in, don't worry about it. It's probably not supposed to at this stage. You know, if you keep on just taking away a little 5%, 10% each time, and you start like, that makes sense. I wonder what Andrew was talking about when he was blah 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 or whatever else. Number one, I'm always here, right? You can always ask me a question. Anytime you want to, you know, ask a question on anything, you know where to find me. So if there's no more questions, fellas, I think I'll finish this one off. I think it's recorded anyway. It's actually up on my live. If anyone missed it, I know there was I think Beef Waffle wanted to.
You love that name, don't you?
I think Beef Waffle wanted to catch it, so maybe he can. I'll share the link in the server so we can access it.
Yeah. Much appreciated.
But as always, fellas, thank you for your time. I hope you got a little bit out of this. You know where to find me if you want to ask any more questions. And have a lovely day, evening, and see you on the next one.
Yeah, I want to thank you, Andrew, for giving us all of your insights, your experiences that you built over the years, the awesome presentation that you do as well. So yeah, so many things.
I think on the next one, you know, rather than talk about theory and education and stuff like that, I think we just review. You know, it's going to be a week, right? So let's review where were all the really interesting times you could have done a trade, and
I love that. Yes.
Like, would this have been a good trade to take? And if so, you know, using a particular system, whatever it turns out to be. But if we do something like that, I think that would be, rather than say, you know, this is blah blah blah. Let's try to think about where the trade would have been good to get into, and let's focus on that. That'll really help us out, I think. So that's the next session we'll focus on, right?
I love that. I'll also try to remember some of the trades that I'll take. I'll mark them in my own Trading View account, that's so I can revisit them with you.
That's a really good thing. Yeah, journaling, trying to take as much, you know, write down what you've done. You know, why did I take that trade? What were the levels? What made me take that trade? Exactly. On reflection, was it a good? Just that self-reflection is actually really. I don't do it. I should do it. I don't. But it's a really good thing that a lot of people do.
I think it makes you a better trader in the end, right? Because you do make mistakes. Everybody makes mistakes, but if you can take your learning from that and avoid it in the next time that you're in the situation like that, that only makes you stronger. So yeah,
I agree. Okay.
Nice.
Well, thanks everyone.
Thank you so much again.
You too, matey. Have a good day. I'll speak to you shortly.
You too. Bye. Thanks everyone. Thank you, Andrew. Bye bye.